This is FRM Part 2, Book 2, Credit Risk Measurement and Management, and the chapter on credit transfer markets and their implications. Now, this is an important component of the identify risk, quantify risk, and manage risk that I talk to you guys regularly about. Transferring credit, really important component. And so there are lots of good learning objectives in the next slide, and we'll focus on these as we move through the slide deck. But I want to tell you just a quick personal story that maybe is a good analogy about transferring risk from one party to another. I'm an old-fashioned dude. I love reading my morning newspaper while I eat my oatmeal or my cereal for breakfast. So every morning I go out to the mailbox, I get my newspaper, and I come back in and have a beautiful, peaceful breakfast. But some days it rains, right? And so some days I don't want to get wet, so I carry my umbrella with me. My grandmother used to call it a bumper chute. So I put my umbrella up, and remember, I just bought a new pair of pajamas, and I have new slippers, and I have new socks, so I don't want to get any of this wet. Plus, I don't want my newspaper to get wet. So as a risk management strategy, I take my bumper chute with me. But what could happen to me on the way to my mailbox? I could trip and fall. There could be a gust of wind and a gust of rain that blows my umbrella away. As I get nearing my mailbox, my neighbor could ride by on his SUV and splash me, and I can get wet, and my newspaper can get wet. All right, so that's a good risk management strategy, but it's not perfect, right? So what could I do? Rather than take that risk myself, given trying to manage that risk, I could go wake up one of my sons and say, hey, dude, can you go out and get the newspaper for me? So my son goes out and takes the risk. Now, my son could take an umbrella, or he could just sprint down there in the middle of a rainstorm and sprint back. But look, my son could trip and fall, right? My son could get wet. But as long as he brings me my newspaper back that's dry, then I'm happy. I transferred that risk to my son. Now, there are other bad things that could happen to my son as he's out there, right? And let's go ahead and take out the love and compassion and protection that you feel for your children, right? Let's take that out of the equation. You know, what could happen? My son could be struck by lightning, and he could be laying down there, and I could be looking out there, and, you know, remember, I'm removing the emotions of this, and I could be saying, look, there's that newspaper. Why aren't I getting my clear and clean newspaper? Here's a great example. I bet you guys don't know this story. Procter & Gamble in the early 1990s tried to hedge about $40 million worth of an interest rate exposure with a couple of derivatives. It used an interest rate swap and it used a currency swap, and it ended up losing $400 million on that. So this is what we've been talking about with the counterparty risk. So my son is out there and he got struck by lightning, just like Procter & Gamble got struck by lightning, and just like let's go back to the 2008 financial crisis. You know, you have Bear Stearns and Lehman Brothers and Merrill Lynch. They got struck by lightning. There were lots and lots of parties that had positive mark-to-market who were waiting to receive those things and to receive their benefits, but they never did. And so the important lesson of this story is that, you know, we're going to try to transfer credit risk, but we can't use some kind of a derivative and then go off fishing and not worry about it. We need to worry about default risk and counterparty risk even through this entire process. And let me show you what I mean by looking at some of these learning objectives. They don't sound anything like rain or waking up sons, but the analogy still holds. All right, notice there's only 4 of these in this relatively short chapter. So we spent a lot of time talking about the financial crisis in 2008, and we'll do that a little bit again today. We need to identify and explain different techniques used to mitigate credit risk, and then we'll take a look at the different ways that banks and financial institutions have evolved over the years in this transfer risk model. We'll take a look at the originate-to-distribute model. And then we'll take a look at some derivatives in the last couple of slides. Some of those derivatives we have discussed before, some of which we have not. The chapter starts, like many of these chapters do, with a brief overview. So let's go ahead and look at credit transfer markets brief overview. So once again, what we're doing is we are trying not to get wet, but still getting our newspaper so that we can read it in the morning. So what does this mean for financial institutions? Remember what we have on the left-hand side of the balance sheet, all of our loans, right? Car loans and mortgage loans and lines of credit, all that stuff. What do we have on the right-hand side of our balance sheet? Well, we have deposits, let's say, and then we can do other things like issue commercial paper or issue medium-term notes or issue bonds. So we've got risks on both sides of the balance sheet. How can we wake up our son and have our son take on this credit risk? Well, there's pretty much two ways that the beginning of your chapter tells you. You can do this through derivative securities, or these novel credit instruments like a credit default swap, where we're essentially making insurance payments to somebody who then promises to pay us in the event of a default. But we can also securitize these loans. Remember, we have all these loans on the left-hand side of our balance sheet, and in the traditional model, which we'll talk about here in just a few slides, in the traditional model as a banker, we wake up every morning and we make these loans, and if they're 10-year loans or 30-year loans, then we have to make sure that we collect the interest and the principal over that entire time period until the maturity date. But what we can do is that we can package those loans and sell them to an investor, right? So that we transfer that risk. Now look at that first block point underneath the blue and rust-colored boxes. Boy, in the early 2000s, this credit transfer market was growing at an incredibly fast rate. And so what happened was that the growth in these types of securities and processes outpaced the ability of investors to adequately identify the risks, quantify the risks, and manage the risk. And I'm going to editorialize here for just a second, although it should not have, but it did. That's why these derivatives and these credit transfer instruments were deeply implicated. Every time this 2008 crisis comes up, you'll hear a politician blame these risky securities that only Wall Street understands. Now look at the bottom block point. It was more of a problem with the abuse of the instruments rather than the instruments themselves. You can't blame the credit default swap because it accomplished what it was designed to accomplish, but the fault lies in identify, quantify, manage. How about a quick status report on the credit transfer market? Notice down the left-hand column, I have likelihood that these types of instruments are going to survive, so under scrutiny, credit default swaps, they're not going anywhere, mostly because the credit default swap market, it's a great market to hedge risk and to speculate, but the price discovery in this market is way too valuable for these things to go away. I teach my students all the time about political risks, and there are substantial political risks throughout the world, but they're growing here in the United States. So we have the federal government who it has its foot, or maybe its legs, or maybe its entire body in the student loan market, but also in the mortgage market as well. So government-sponsored mortgage-backed securities, they'll probably survive, and they'll probably evolve to become, I don't want to say safer going on into the future, but at least more easily recognizable in terms of risk assessment. Asset-backed commercial paper, the traditional model. Now, remember, large corporations and large financial institutions, they have historically gotten away with just issuing commercial paper that's unsecured, right? They'll just say, hey, lend us $25 billion over the next 270 days. And here's our cash flow model. We generate lots of cash flow, so we'll pay you back. But investors like security. They like to have their loans secured. So commercial paper has evolved so that it includes asset-backed commercial paper. So a corporation or a financial institution can issue commercial paper that is backed by particular assets, like, let's just say, an accounts receivable. Non-real estate backed securities, like credit card receivables and auto loans. I mean, look, people are borrowing money, so these things will probably be around, right? But under scrutiny, sure, I'm okay with that. Moribund with a low likelihood of reemergence. There's a good word for everybody to learn today. That's how I feel as I'm approaching. I'm a year and a half away from being 60. Am I approaching death? Sure, I hope not. I hope not. But some days I feel like I am. And so these things are probably not going to be around. The collateralized debt obligation market, took some big hits, particularly because of the inability of lots of investors to be able to not only identify the risks in this, but also to quantify them. And so the CDO squared, that's just a term to describe a derivative in which you buy a bunch of collateralized debt obligations. So those things are probably going away because they're essentially double derivatives. And by the way, if you do any search on this, there's a CDO cubed as well. I don't even know what quadded might mean, but surely imagine there's a financial institution person out there who would create it if somebody would buy it. Single tranche CDOs, those things are not too terribly interesting, and so they don't provide the spectrum of spanning that investors demand. And then the non-traditional asset-backed commercial paper. Non-traditional just means that they're backed by some asset that is not really traditional. Those of you who have seen some of my previous videos, I use in a couple of them, I use the Pink Panther diamond as an example of collateral. And so if a financial institution has something unique, some kind of a non-traditional asset, they could use that. And so that's probably going away because, using my silly Pink Panther diamond example, it's tough to value it. It's who knows about its liquidity, et cetera, et cetera. Low state convalescence, potential fast revival. The collateralized debt obligation market, typically it started and typically included, just things like corporate bonds, but then it advanced. And so now you have these collateralized loan obligations, which, if you look at the bond market, it might be this big and might have this much of a span, but the loan market might be bigger. There's no reason why private entities can't package mortgages into a mortgage-backed security. How about revived post-crisis markets? Structured loans, these are good, covered bonds, and then re-securitization. What happened in 2008? After 2008, you had the ratings agencies then downgraded lots of these underlying securities and the derivatives themselves. And so this re-securitization is actually kind of interesting because typically what can happen here is that you re-securitize a product that had been downgraded, but there's really nothing interesting about re-securitizing the entire product, but maybe just a particular tranche. And I think the most common tranche is a junior tranche or an equity tranche, because nobody's really interested in that first tranche where you get the payments, whether it's the coupon payment or the refinancing payments on the mortgage. The risk, the higher returns occur down in those bottom tranches, or at least the last tranche. Well, I just talked about re-securitization, so let's go ahead and talk about securitization. I'm guessing you guys know about this. The practice of repackaging loans so that those securities can be sold to other investors. And of course, the advantage is, and we'll talk about this in the next couple of slides, the advantage is that you or I, we can't get into the mortgage market. But what we can do is we could buy a security that gets us exposure to the mortgage market. So of course, this means that we have to examine this originate-to-distribute model as opposed to the traditional buy and hold model, where a financial institution wakes up every day, has individuals and businesses come into their office, and then they make these loans. And if they hold them into maturity, then it's the financial institution loan officer's responsibility to make sure that those coupon payments or the interest payments and the principal payments are all made in a timely and full manner. Well, think about how stressful that is over a 30-year mortgage. You got to get in your car and drive to the homeowners every 30 days and knock on their door and say, where's my payment? You got to do that for 30 years. Or you can just originate the mortgage loan and then distribute it. You can package it into a security and then sell it and let somebody else worry about going and collecting those interest and principal payments. Now, that somebody else who's responsible for collecting those payments might be you, but you're not responsible if there is a default. Look at the green check marks over here. This is what financial institutions tell us all the time, right? Greater capital efficiency, enhanced funding ability, broader assortment of potential investments, and this is absolutely true. And then more diverse product range and lower borrowing costs. Boy, that's a good one down there, if in fact it turns out to be true. Now look at the final block point down there. In the years preceding the crisis, these benefits were progressively weakened. All right, so I want you to think about, go back to the Bill Clinton years in the United States. Think 1995, 1998, 1999. What did we have? We had a tremendous economy, lots and lots of growth, right? And Bill Clinton announced at one point, I forget what year it was, 1994, the era of big government is over. And so there was some deregulation, and so there was lots and lots of leeway for these types of securities to be created and then to evolve. But then, you have the George Bush years. So think 2001, right? Lots of bad things happened in 2001. And then you have a recession, and then you have some wars, and then you have, all right, so you've got these financial institutions who are expanding their asset base. At the same time, the economy is struggling and investor sentiment, it's all that kind of stuff. So this led us all the way up to the 2008 financial crisis. And so the risks and losses began to accumulate. All right, so the risks are going like this, the potential losses are going like this, and lots of us were unaware of that. I talk to my students a lot about this financial crisis. So what are the flaws in the securitization of subprime mortgages prior to the financial crisis? And so let me just give you my quick summary. Back in, let's say, 1998, you had these mortgage-backed securities that were rated in high investment grade by the ratings agencies, and they probably should have been. But then you've got, transitioning into the George Bush years, we've got this major event in September of 2001, and then we have the follow-up of the military spending and all the tremendous spending here, coupled with a recession or a near recession, or at least we felt like it was a recession. Couple that with expanding home ownership, and those mortgage-backed securities, they were bound to fail. But just fast forward to like 2004 and 2005, that the standards for granting an original mortgage were substantially less than they were just 10 years prior to that. So, this is what I do. I tell this to my students all the time, that, homeowners should be buying a house that's this big, right? But because of all of this extra stuff that I'm just talking about, homeowners were buying houses that were this big. So you got people in houses that they probably shouldn't have been in. Now, one of the big problems was this conflict of interest. And so let's think about this. If you're a financial institution person and you have to make certain that that person is going to repay the mortgage loan over 30 years, boy, you're going to sit across from that person and you're going to say, tell me all about yourself. What are your assets? Do your parents get involved in this? Do you have any cousins who are wealthy? All this kind of stuff. But if you know that you're going to package this mortgage with a bunch of other mortgages, then the temptation is not to do the complete individual client research necessary to manage that risk over a 30-year period. So look what I have in bold there, a quick short-term profit without retaining any risk. So this was a big problem, this conflict of interest. Now, how about the complexity of these structured products? And so, boy, I know you guys get sick of me saying this. Identify the risks. So look at that first block point, a general lack of understanding of structured products. So if you don't understand what these products do, what their functions are, and what their cash flows look like in various scenarios, that's why I repeatedly tell my students, and hopefully you guys remember this as well, is that, one of my favorite things is an interest rate tree. So you start here and you have all these branches so that you can figure out what's going on in the future under all of these conditions. And the simple case of an interest rate tree is when interest rates rise or when interest rates fall. So if you don't do that interest rate tree or any other kind of a tree analysis, then you're probably going to rely on somebody else. So look at that last block point. Based on the opinions of ratings agencies or other financial institutions or. And of course, we suffered from the herd mentality, 2005, 2006. Everybody said, oh yeah, the mortgage market, it's different this time. We're still going to take off and we're going to take off and we're never going to crash. Whoops, sorry, I didn't mean to go back there. All right, so how about risk retention? Here's one of the fascinating things about history and learning about history and going back to 2008. Look at that first block point. Banks bought a large amount of securitized products from other banks while selling some of their own. Look at that, $900 billion of subprime mortgages. So think about what happens in that the financial institutions got away from their traditional role of accepting deposits and making loans, and they could make this quick profit by packaging those loans and selling them to other investors. So they were on the demanding side and they were on the supplying side. And of course, part of the motivation for financial institutions in pursuing this kind of a strategy was that there were new government regulations, new governing body regulations, new suggestions, new best practices after the 2008 financial crisis that said something like, look, you look on your bottom right side of your balance sheet, you used to have this much in equity or capital, let's say. Now you need this much. And so it provided an incentive for financial institutions to say, all right, we need to have this much. What can we do over here? What can we do up here to get to that much? So there was a tremendous interest and advancement in these special purpose vehicles or special investment vehicles. Look what I have in the bold down there. Get around capital requirements. There are always unintended consequences of rules and regulations. When I tell my students about the financial crisis and who's to blame, I lay it at the foot of lots and lots of different kinds of people. We've talked about them in the previous slide, but one of those people has to be the ratings agencies who, I guess in the simplest of senses, you could say that perhaps they got lazy or perhaps they didn't do as much research as they should have. But the problem is that the ratings agencies are not paid by you and me, the bondholders. They're paid by the issuers or the originators. All right, so you've got this scenario under which the balance sheet of a financial institution is becoming less and less long-term on the asset side, right? We don't have to worry about receiving the interest and principal payments over 30 years. We're doing short-term stuff, so we might have to access the short-term market. And so we're probably going to try to roll over our debt using commercial paper markets. What did we say in one of those previous slides? So you have traditional commercial paper, and then you have asset-backed commercial paper, and then you have the asset-backed commercial paper that has non-traditional types of collateral. So over-reliance on the short-term funding market probably has implications in terms of liquidity and marketability, especially if there is a housing bubble burst. All right, how do we lessen or mitigate credit risk? Historically, whenever a U.S. municipality would want to borrow money, whether it was a state or a city or a county, what it would do, it was open up its books to potential bondholders, and the bondholders would say, okay, what's your tax base? How are you going to repay this loan? And the municipality would say, oh, look, I got a lot of rich people over there. They pay property taxes, or they pay these kind of taxes. And so the investors would say, okay, that's fine, but suppose that those people move out over the next 30 years. And so the easiest thing would be for the municipality to go find a financial institution, like an insurance company, that will say something like, hey, we'll help pay for interest, probably not interest, but maybe those principal payments. So this was a credit enhancement. And so what that does is brings in the specter of default risk of the insurance company or that financial institution. Collateral, we spent lots of time talking about collateral, so that should be self-evident. Marking to market. The problem with marking to market is that if we're on the floor of the Chicago Mercantile Exchange, marking to market is relatively easy because you have lots and lots of investors, lots and lots of hedgers, lots and lots of speculators who are using their own capital, let's say, to buy and sell, to take long and short positions, to bet on the movement of the underlying asset value or asset price. And so you can pretty much take at face value that daily marking to market. But if we're trying to daily mark to market the gains and losses based on my Pink Panther diamond, well, that's a little bit more challenging. How about letters of credit? This is an example that I always give my students. These things have become extremely critical to facilitate international trade. Let's suppose that you're a California peanut farmer, and you get an order from an Iceland peanut butter manufacturer, and this person calls you and says, hey, I want you to send, boy, I'm making this up, I don't even know, 1 million pounds of peanuts to me, and I'll pay you, geez, I don't even know how much 1 million pounds of peanuts would cost. How about, let's say, $10 million. And so, if we lived in a perfect world where we trust everybody and everyone is default risk free, then it wouldn't matter whether you sent the peanuts first or the dude from Iceland sent you the $10 million first. Each of you would be satisfied by that transaction. But of course, you don't know this person over there, and he or she doesn't know you. So you go into this back and forth. Will you send the peanuts first? Will you send the money first? Well, the only way this can be solved is to bring in a financial institution. So you call up a financial institution, and the person in Iceland says, look, will you guarantee payment of $10 million in 20 days or in 30 days or whatever that terms of the contract are? So now everyone's happy, right? The peanuts get sent, and then in 10 or 15 or 30 days, then the 10 million gets sent, and so everyone's really, really happy. Of course, the one of the parties can sell that. That's when it becomes a banker's acceptance, and that's a completely different market as well. And so think about what's happening. You have a financial institution, and it could be a bank in California. It could be a bank in Iceland. It could be the Tooth Fairy Bank, right? Just as long as there's a bank who's going to guarantee the payment at some date in the future. Now, look, if it's a California bank, and this California bank has been around since, we've been around for 1,000 years, this California bank, we're guaranteed to pay. Or it could be an Iceland bank, and so they would say, look, we've been in Iceland since the Ice Age, we're going to pay. So you got to worry about the financial reputation and the stability of the bank that's issuing this guarantee. Now, of course, if it's the Tooth Fairy Bank, you got to worry about this because, kids, they don't know they even believe in tooth fairies anymore. So that's a silly example. But, right, there's lots more default risk or counterparty credit risk for the Tooth Fairy Bank than either of these other two banks. And then we spent lots of time in previous chapters talking about the value of netting. And so if you and I have 20 different trades with each other, 20 different underlying derivative contracts. Some of them are going to be positive mark-to-market. Some of them are going to be negative. And so we need a mechanism under which we net all of those trades, because it might turn out that I might owe you $100 million on this trade, and you might owe me $30 million and $40 million and $30 million on 3 trades. And so wouldn't it be just easier if we netted those transactions? Of course. Corporations, including financial institutions, love to issue bonds. And over the years, most of these bonds have been what are now referred to as option-free. But many of them, especially in the last 20 years, have had what we call embedded options. They can have a call feature or a put feature, like in this case. And what the put feature does is it gives the bondholder the right but not the obligation to do certain things. And that put option in its simplest state could be force the issuer to repurchase those bonds at some date. Like if interest rates go up, price of the bond goes way down, right? If you sold it in the secondary market, maybe you only get $800 or $900 for it, but you can force the issuer to buy it back from you for $1,000, right? So look at that second block point there, right to force early redemption at a pre-specified price. And then, of course, loan syndication. This has been going on for thousands of years, right? And so when a business goes to a bank and says, I need $1 billion to do this, the bank will say, boy, I wish I had $1 billion. I'm not a gigantic bank. And even if I were, it's probably too risky. So why don't we bring my other banker friends in here and syndicate this loan? Now, of course, sending our son out to get the newspaper transfers risk to our son. But what if our son is kind of a knucklehead and forgets to take his umbrella or gets the newspaper out of the mailbox and then trips and falls coming back into a puddle so that the newspaper is all wet and it's torn, right? So these techniques, they're pretty good, but they're not perfect. So what are some weaknesses in having our son go out and get our newspaper from the mailbox in the middle of a rainstorm? So look at that first point there in the last bolded. Very little credit risk management is carried out. But you should be scratching your heads. You should say, all right, Jim, you've taught us this for many, many videos. All right, so look, once that lending decision has been made, and let's face it, financial institutions, they have traditionally done a pretty good job, and they still do. Even if the intent is to distribute and sell these loans, they still do a pretty good job at initiation. But then very little credit risk management is carried out. Let's take 2020 as a perfect example. Suppose that a financial institution makes a multi-million-dollar loan to a married couple who owns a barber shop. Husband and wife, they cut hair and they do nails and they put eyelashes on people. Apparently that's a thing these days. And they're the most popular barber shop, in the entire city. And so people call and they wait in line and they come and they say, I got to go to this husband and I've got to go to this wife. And then we have a virus and the government comes in and says, you are not a essential business, so you need to shut down. So you have a great credit risk in January, let's say, but by March you have a terrible credit risk. So that's an extreme example, but it's important to understand the consequences of not continually managing that credit risk. How about a second one? Loss reserves are only based on expected loss. Oh, this is a really cool one. Look, remember in that last, I think it was that last chapter, maybe a couple chapters ago, we computed an expected loss where we needed a probability of default, just some regular probability of default. And then we stressed that probability. Remember, we called it a stressed probability of default. So if our regular probability of default was, let's say, 1%, maybe our stressed probability of default was 4% or 5%, and we got some stressed loss. And so think about the difference. If you remember those examples, those differences were pretty substantial. And so unexpected losses are generally ignored. Stress testing, this is extremely important. How about this third one here? These techniques lack flexibility, right? And so it's really difficult to unbundle the credit risk from these underlying positions, so that you can look at this as kind of an umbrella type of an investment. And so based on those three reasons, look at the bottom arrow point. New risk management strategies that will attempt to overcome these shortcomings. And the example that not just this chapter, but multiple chapters kind of swing back to is a credit default swap. And, I don't know how long ago it was, maybe in the 2000s, I probably just mentioned credit default swaps in my investments class, and now it's a huge part of it. Here's a slide that kind of summarizes what we've been talking about, comparing a traditional approach in which we originate and hold these credit assets until maturity. We just call that the traditional approach, versus a portfolio-based credit portfolio management approach. So look at the second, that's first and second circle point there up at the top. A set of principles and tools and processes. All right, so what does that sound like? Identifying risks, quantifying risk, manage risk, that underpin the management of credit portfolios. It's an aggregate portfolio setting. All right, so look down in the blue box. Credit portfolio management centered around underwriting and then distributing credit risk to other investors. So think about what that means as a financial institution officer. Your job historically has been to welcome clients as they enter your bank and say to them, okay, what do you need our money for? And they'll say something like a car or a home or a beach house or a swimming pool in our backyard, right? Well, now, under this credit portfolio management strategy, now you have investors coming into your bank and they say, look, we have millions of dollars. What can we do with it? And you have to say something like, oh, well, here, put it in a checking account. We'll pay you 0.05% interest. Well, of course, that's no good. So you got to come up with a series of securities that don't look like the regular old fixed income securities that they can get in the bond market, or equity securities that they can get in the floor of the New York Stock Exchange. You want to provide them with opportunities to invest in things that are based on your assets. So what do I have down there at the bottom? Strategies such as securitization, outright sales, or credit derivatives. All right. So now, as a credit portfolio manager, not only do you have to be sensitive to those clients who are coming into your office who want to borrow money, but you want to be you need to be sensitive to those clients who come in who want to make investments. Let's take a couple of slides here to examine the differences between traditional and portfolio-based approach to credit risk management. All right, so we've talked about a bunch of these here. Banks originate and hold loans until maturity. They own all of those credit assets in the traditional form. But over in the portfolio-based form, the total loan portfolio is then chopped into the core loans. And so that there can be some where the financial institution says, yes, we want to hold these until maturity, but these over here, we want to securitize these. And so there's a separate business unit that's going to manage those loans that can be securitized. And remember, just because they can be doesn't mean that they should be. Now remember, when these individuals come into your financial institution, you're either going to say, hey, yes or no. And remember, as financial institutions, you really don't want to turn people away. What you want to do is charge them an interest rate based on their level of risk, however you want to define risk. I've said this to you guys before. It's not like Sam Walton stands outside of Walmart and as you're walking in and he says, what do you want to buy today? You say, well, I want to buy a vacuum cleaner. He's not going to say, oh, Target has great vacuum cleaners, right? Now, here's an interesting part of this traditional model that, of course, the compensation is based mostly on volume. So it's the job of the loan officer to make as many loans as he or she can possibly make. Now, in a portfolio-based model, however, that these approvals are not necessarily going to be a binary choice, but the choice is going to be, yes, we can do this, and we need to figure out what the risk level is so that we can charge higher interest rates for higher risk clients. Compensation then is based on risk-adjusted performance, and this is a topic, and this is part of a model that I'm guessing you guys learned long time ago, even in your undergraduate days, risk-adjusted performance. In the traditional model, of course, the pricing of these loans depends on what's happening down the street, right? The competition in the local banking market. If there are 1,000 banks on the street and we're just one of 1,000 banks, what are we going to do? We need to make certain that we get the people walking into our bank versus those other banks. And typically these are valued at book value, but the portfolio-based approach, of course, if they're going to include things like derivatives, I don't even know what a book value of a credit default swap might look like, but I'm sure you could figure it out. But of course, these have to be market values. And then rather than looking at individual loans by themselves, right? When I went to the bank and wanted to borrow money for this house here, the banker looked at me and said, okay, how are you, Jim, and your wife, how are you going to repay this loan? And the decision to accept or reject my application probably didn't depend too much on, my neighbor's applications, et cetera, et cetera. But in this portfolio-based approach, this is exactly like investors view their fixed income and their equity portfolios in terms of a beta, right? How much risk does this particular loan add to the risk of the entire portfolio? Here's just a quick slide about the volume and the amount of credit derivatives. If you do a quick search, and it sounds something like, what is the total size of the derivative market? I saw a word that I don't even know what it means. It says it's quadrillions of US dollars. Here, this is just credit derivatives, and those are trillions of dollars on the right. I don't even know what trillions of dollars, 750 trillions of dollars. I can't wrap my head around the amount of that. And of course, those are notional principles. So it's not that it's meaningless, but it doesn't have too much meaning there. I mean, the point is, you go back to 2004 all the way up to through 2019, is that these things have grown tremendously. And notice that the big slope was, in the Bill Clinton years and then the George Bush years. That's a pretty steep slope leading up to the 2008 crash. But then we've been pretty static in the last, from 2008, over the next decade. All right, how about types of credit derivatives? Here's my favorite, credit default swaps. And this works just like an insurance contract. And we've talked about this multiple times, so I probably shouldn't need to spend too much time with you. But essentially, what the protection buyer is doing is making a series of payments to a financial institution that says something like, hey, I will pay you $10,000 every 3 months over the next 3 years if you agree to pay me some huge number, the par value of the bonds that I own, or some kind of a loan that I own, whatever it is. And so look at the top flow chart there. This works just like insurance on our car. What do we agree to do? And the interesting thing there is that I make my car insurance payments quarterly. So I do this every 3 months. So I send payments to the insurance company, and I'm hoping that I never have to call them and say that we've had an accident, right? But switch down to below the horizontal black line. If I do have an accident, then the insurance company then makes me whole. And if there is a default or a downgrade, and there are lots of different ways to construct these things, then the financial institution will pay me. Now, of course, the way it works here in this flow chart is that the protection seller will pay me the par value of the bond. Let's just say that's 100, and then I have to deliver the bond to the protection seller. And so that financial institution will just go sell the bond and recover part of it. The delivery of the bond is probably not $0. Even in the Enron bonds, I think they were worth 11 cents or something like that. I made up that number, by the way. How about swaps? Swaps are really, really fascinating. Back here, credit default swaps. They're called credit default swaps to make it look like it's a credit derivative. And in fact, it is. It's essentially an insurance contract, but there's no way that the financial institutions were going to call these credit default insurance contracts, because then you would have lots and lots of insurance agencies and insurance governing bodies and government bodies coming in and say, we're going to regulate your market the way we do car insurance. So it's called a credit default swap. But these things here, interest rate swaps and total return swaps, these are swaps in the traditional sense that all we're doing is swapping cash flows. And so with a total return swap, forget about the borrower down there at the bottom for a minute. All we're doing here is we are agreeing to make a fixed payment, right? There's the green arrow. We're going to make a fixed interest payment, and we're going to agree to receive a floating rate payment. So this is just a fixed for floating rate swap. And you can arrange swaps for almost anything that generates cash flows. Even if they don't generate cash flows, you can organize it so that it looks like you're exchanging cash flows. But in this example, notice what's happening here. The first bank, the green bank over on the left-hand side, makes a loan and receives loan payments. And they're probably fixed payments, right? And so one way to transfer this interest rate risk is to pick up the phone and call somebody else. So let's go ahead and identify the risk. What is the risk that the green bank has? Well, they're receiving fixed payments at a fixed rate. Let's just say 5%. So what happens if interest rates go up to 8% or 10% or 12%? The borrower, the orange borrower down there, is coming to the bank every month and saying, I'm so delighted to give you your 5%, because if I had to borrow this money today, I would be paying 10 or 12 or 20, whatever I said here in just a second. So what happens to manage this risk is that the green bank picks up the phone and calls somebody else. Maybe it's another financial institution. We learned that in a previous slide. Maybe it's just some other kind of an investor. And we pick up the phone and we say, hey, look, I'm receiving these fixed payments. How about if I ship them off to you? Will you take these payments? And the investor over there says, sure, what do you want from me? And the green bank says to the blue investor, look, all I want are floating rate payments. How about we say LIBOR plus 100 basis points or 200 basis points or whatever it is. And so what happens is that the green bank has really managed its interest rate risk by turning it upside down. Now it's exposed to the opposite, the reciprocal of the interest rate risk, right? Originally, it was worried about interest rates rising. Now it has to worry about interest rates falling. But the focus here is on the blue investor over there. What happens to the blue investor? What the blue investor now receives is this fixed payment. So it knows it's going to get 5% all the time, and all it has to pay is LIBOR. Let's say LIBOR is 1 or 2% plus some spread. So as long as interest rates stay low, then that blue investor wins. How about a first to default credit default swap? These are relatively interesting things. With a traditional credit default swap, you have one bond or one borrower. And so it's pretty simple that, look, if this particular corporation, like Johnson & Johnson, defaults, then the financial institution will swoop in and make that $100 par value payment, right? But of course, investors don't hold just one bond. They hold portfolios of bonds. And so it makes sense then that we can put a bunch of these bonds into a basket and say, I want a credit default swap based on these 5 loans or these 10 loans. So then you have to figure out what the default event is. Maybe it's pretty easy to figure it out when there's only one bond. But now when you have 5 bonds or 10 bonds, boy, what do? Well, you can have a first to default credit default swap or a last to default credit default swap, or however you really want to figure it out. But your textbook mentions this first to default credit default swap. So of course, the first time one of these bonds defaults, then the financial institution has to come in and make that payment. Now, as an investor who's buying these first to default credit default swaps, it makes no sense at all to put 5 bonds in there that have a 1 correlation coefficient, because when one defaults, then all of them are going to default. So you'd have to pay way, way too much for this kind of a thing. Now, the end of the chapter has a great discussion on credit link notes, and these are really fascinating items. The textbook and any research that you will do emphasizes the complex nature of these things. So we need to spend lots of time on identifying, and then lots of time on quantifying, and then maybe even more time on managing. And so a credit link note is simply a security that most people believe has a credit default swap in it, and it does, but it has an embedded credit default swap. It's not an explicit one. It's not one that works like the credit default swaps that we've just been talking about. But what this does is this transfers risks from one party to another. And so the way these things work is relatively simple from a big picture perspective. So let's suppose that we're a financial institution and we make a loan. It could be one big loan or it could be a bunch of loans. And so we're exposed to the risk that the coupon payments and the principal payments are not going to be made in a timely or full manner by the borrower. Maybe it's a 10-year loan, maybe it's a 30-year loan, and we don't want to worry about this. And so how can we transfer that risk? And so this is what we do. Remember now, as a financial institution, we have lots of investors who are walking into our bank who have millions of dollars to invest. So what we do is we say to this individual who comes in and says, I have $10 million or $20 million. And what I want to do is I want to get exposure to the local economy. And so you say, well, wouldn't you know it? I just made a $100 million loan to a baker that has his or her manufacturing facilities all the way over there in the east end of town. So we say to the investor, why don't you let me have your $10 million? And I'm going to take that $10 million, and that's cash right now. So the principal is being exchanged. So this is called a funded derivative, right? So you say that to this investor, look, what I'm going to do is I'm going to take that $10 or $20 million, and I'm going to go buy some treasury securities. All right, so we're using this treasury securities in a collateral. All right, what I'm going to do then is I'm going to take this loan, maybe it's $100 million, and I'm going to put it into a trust. And I'm going to take these $10 or $20 million worth of treasuries, and I'm going to put them into that trust. So notice what happens. For $10 million, the investor gets exposure to $110 million worth of collateral, so to speak, that's in this trust. Now, this trust could be an on-balance sheet trust, just a regular old trust, or it could be a special purpose vehicle that takes it off the balance sheet. And the structure of that trust is not really too terribly important for this chapter and the purposes of this chapter. And so the investor says, all right, so I understand what you're going to do. What do I get out of it? And you say, look, you're getting exposure to this risk. We've got some collateral with the Treasury. Now, that collateral doesn't fully cover the entire size of the loan. But what I will do is, that baker is probably not an investment grade baker. Maybe it's a double B or a single B. So what I will do is I will pay you a floating rate of interest with a number of basis points based on the credit risk of that baker. So what I've done is I've transferred that credit risk to you. Your cash flows depend on the quality and the ability of that baker to make those interest payments, right? What have I done? I've transferred that to you. You're happy because you're now getting a higher interest rate in the form of higher coupon payments. Now, the way this ties together is that I'm selling you a credit-linked note for $10 million. Now, what happens is that if the baker makes all of his or her payments in a timely manner, all of us are happy. But if not, then you have to suffer the losses. The investor has to suffer the losses up to that first 10 million or 20 million, whatever I said. You see how it works like a credit default swap. You paid me the 10 million at initiation, but if there's a default, I don't have to pay you that 10 million. So it's kind of like a credit default swap. Let's go ahead and look at an example of a credit-linked note and maybe put some mathematics to this. And then let me give you just a pre-warning here. We'll go ahead and look at a flow chart as a summary. So let's look at this example. Let's suppose that we have a $100 million non-investment grade loan. So there's the baker. Now, what I didn't say to you in that previous slide is that as this bank, I could have made that loan to the baker like I just described to you, or I could go out and buy it from another financial institution. So in this case, we buy an asset that's worth $100 million in the form of a non-investment grade loan, average rating of single B, and so it's going to yield LIBOR plus 250 basis points. Now, I paid for this as the financial institution. I paid for this with my own funding, right? So I have to pay LIBOR over on the right-hand side of my balance sheet. So whether I made this loan myself or I bought it from another financial institution, my cost of funding is that LIBOR. Look at that second block point there. The bank is not very confident about the seller's ability to service the loans to maturity and feels there's the need to hedge the risk. All right, do you see how this, makes life a little more complex? So if I make that loan, and this is what I said to you on that previous slide, if I make that loan as the financial institution, I might be worried that the baker is not going to be able to repay that interest in principal. But in this case, if I buy the loan, I might be worried that the selling financial institution might not be able to service that loan, which probably depends on the baker's, credit rating. All right, so either way, there's a need to hedge this risk. All right, so there's an investor, $100 million of exposure with a leverage ratio of 5. So here's this investor walking into our financial institution who has $20 million in his or her pocket. All right, so what I do is I take that $20 million and I go and I invest in a government security, right? U.S. Treasury bond. Notice down there, that second to last block point, there the yield is 5%. All right, go right one above it. I transfer the reference asset into a trust and then issues the credit-linked note to the investor. And then I, the bank, promises to make that payment to the investor through the trust of 150 basis points. All right, so let's look at what this visually, we can observe in the green and the orange and the blue, right? So there we are over on that side. We're the bank, right? There's this person coming into our bank, the blue investor, over on the right. All right, so think about this. We got this client coming in who has $20 million, who says something like, look, I want leverage of 5. I would love to invest in that bakery down there, but it's privately owned and I can't invest in that bakery, but I know you have a loan to that baker. I want some of that. And of course, the investor doesn't have to know anything about the particulars of the loan, only that it's non-investment grade. So how can we structure this relationship? Well, we go ahead and say to the investor, all right, let us have your $20 million. We're going to go out and buy $20 million worth of treasuries, put it into a trust along with the $100 million in the loan to the baker. Right? Of course, look at the blue line and the green line at the bottom. There's the credit-linked note certificate that outlines our relationship between the bank and the investor and the stuff in the middle. And that stuff in the middle is the original loan and the treasury. You see how that treasury works as some kind of a credit enhancer, some type of a risk mitigant. All right, so what's happening here? Notice that the green from the bank to the trust is the 150 basis points. And then what's happening is that the investor is receiving from the trust LIBOR plus the 250 basis points, right? Plus, notice at the top of that arrow, any loan price change, right? If the credit of the baker improves, then the investor has the opportunity to realize that appreciation in value. But if there is a default, then the investor has the obligation to realize that loss. So let's go down to the bottom, assuming no default. This is where everyone is happy. So the bank's net cash flow is simply the 100 basis points. So this is what the bank gets in return for transferring that credit risk. And so really all we're doing is taking the LIBOR plus the 250 minus now that comes from the trust, minus the LIBOR, which is our cost of funding, minus the 150, which is what we promise to pay the trust, which then flows to the investor. Now, what does the investor get? Look at this, 12.5%. That's 5% times the 20 million, right? 5% coupon from the U.S. Treasury. I think on the previous slide we said that yield was 5%, so we're just assuming that the yield and the coupon are the same, so that those treasuries are selling at the par value, plus the 150 basis points times the $100 million of the baker's loan. And of course, we have to chop that by the $20 million. So that gets you to the 12.5%. So what does the investor get out of this? The investor gets enhanced returns. So assuming no default, everyone's happy. But, and that's a big but, what happens if there is a default? So the blue investor then has to absorb those $20 million in losses from the baker. Now, the baker has a $100 million loan, so maybe those losses are $15 million, but maybe they're $25 million, or maybe they're $30 million, or maybe they're $100 million. So if there's a default, the bank is only covered up to the $20 million. If there's a $40 or a $60 million default, then the bank suffers the losses. And so notice that this is an example where everyone wins if the baker can repay the interest and principal, but not everybody loses if there is a default. There are cases under which everyone does lose if that default exceeds the $20 million. But you see that the bank is protected against those first $20 million worth of loans. So I'll let you be the judge of whether or not this is a complex credit derivative or if it's relatively straightforward based on, the relationship between the green and the blue as they meet in the offices of the financial institution. And I think that takes us through these 4 learning objectives. Boy, what are the important things in here? I would be able to discuss those flaws in securitization. That sounds like a really good multiple choice descriptive question. And then the second one, I think that's probably the most important here. Identify and explain the different techniques used to mitigate credit risk. So talk about the credit link note, the credit default swap, and all the other information on those slides. Also know the difference between the originate-to-distribute model and that traditional model. And then, boy, what am I saying? Each one of these is important to know. So this is probably a really important chapter. There doesn't seem to be too much math in the chapter, but I would be prepared to at least understand how the netting works in some of these trades.